private debt is only for large corporations.
Definitely a
Myth or
myth.
fact?
Definitely a myth.
Hello, everyone. Welcome to Financially Focused with Cardinal Stone, where we break down important topics in Nigeria's financial markets and help you make smarter financial decisions. I'm your host, Oscar Romero, and today we are tackling a critical question for Nigeria's economy. Can private debt solve Nigeria's SME growth problem? SME, small and medium-sized enterprises. They are often described as the backbone of the economy. But if you speak with many business owners, the same challenge comes up over and over again: access to the right kind of financing. And so today we'll be unpacking why SMEs struggle to access funding, why traditional bank loans may not always be the best fit, and how private debt can help to offer a more flexible, scalable solution. To help us explore this very interesting topic, I'm joined by Aweli Anene, a debt solutions specialist from Cardinal Stone Finance, who works closely with businesses to structure financing solutions.
Thank you very much, Oscar.
Aweli, welcome to the podcast.
Thank you.
So let's start with the big picture, right? We always like to start with the big picture. SMEs are everywhere in Nigeria, yet access to finance seems to be such a huge problem. Why is this problem so consistent?
I think that we're aware that SMEs provide a lot to the economy in terms of economic activities. But in terms of financing, they're underserved. Now, I hear a lot of people say that the reason why SMEs don't have access to financing is because there's no money. But honestly, the truth is that there's money, but the options of financing doesn't match business needs. So there's a mismatch between what the business needs and what is being provided. For example, a furniture making business, a furniture manufacturing business has just won a contract with a school. And from sourcing raw materials to producing the furniture to delivery and then to getting paid will probably take 7 months. Now, financing options available for that business will probably make the customer start paying in 30 days. We can see there's a mismatch, and definitely the business is going to struggle to repay that facility. And this cuts across several sectors. So we have a healthcare business that wants to expand, get a new amenity, or you have an FMCG distributor that wants to stock up in view of the festive periods. All of these businesses are viable, but financing options are very limiting. Now, traditional lenders are typically risk averse when it comes to financing SMEs, and so they'll concentrate on your financials, historicals, audited financials, and all those kind of things, and then maybe repayment structures that will not align with cash flows. Just to sum that up, many SME businesses are viable. It's just that it doesn't fit into the conventional lending structure.
That's interesting. So it's not that the capital doesn't exist, it's that the structure of available funding doesn't always match the SME's need.
Definitely. Capital is available and money doesn't solve everything. The appropriate structure solves it.
I like that word, structure. And so the money exists. I mean, I've been thinking of starting a business, so it's good to know that the money is there. I just need to find the right kind of. So let's talk about traditional bank loans, because when a business owner thinks about starting a business or they are looking for financing, that's the first thing that comes to their mind. Why don't traditional bank loans always work for SMEs?
Okay, so we know that the banks have played an incredible role in terms of financing. However, the loans are based on strict credit policies. So every business is different. So definitely financing options may be different. Now, in terms of financing SMEs, banks typically price it based on the risk that they perceive. So it's usually higher risk for them, higher interest rates. So pricing is a huge issue there. In terms of structure also, many people don't see SMEs in the long term, and typically will structure a shorter term facility, which will not allow those customers breathe, And then finally, I'll say that collateral structure, because they expect these businesses to be very risky, collateral that they require typically very stringent, and SMEs may not be able to provide those.
Interesting. So for a growing business, is that for a lot of these traditional bank loans, because a growing business is trying to scale, some of these bank loans sort of, slow their growth rather than actual supporting of it.
Definitely. If your loan is not tailored to your business, it's going to hinder your growth. Now, if a business is meant to use its cash flow or income to expand, and instead of those funds are going to repaying a bank debt, obviously we can see that that bank or that business is not going to grow.
Okay. I mean, we've talked about the problems. You've talked about the access to funding, why bank loans aren't working. Let's talk about private debts, because I mean that's what we said. The topic of today's podcast is private debt. Many people listening may not exactly understand what it is. I mean, even I'm not sure I know what private debt is. What exactly is private debt?
All right, so I'll explain non-bank private debts. Now, non-bank private debts they're basically debts not availed by commercial banks, but investment specialists and alternative lenders, providing financing structures that align with business objectives. Now, they can come in different structures, can come in form of term loans or structured credit facilities. But the main difference is that it's flexible and it offers a structure that aligns with the customer's needs.
So in simple terms, private debt is customized financing designed around the business rather than fitting it into any rigid loan structure.
That's what it is.
That's interesting. So let's get practical. How exactly do this private debt, this non-bank private debt, how exactly do they support the growth of SMEs?
All right, so I would answer that question with if with a transaction we concluded some years ago. We financed a fitness business. The fitness business was trying to expand and needed to, get some equipment so that we can have more. They can have more clients. The way the financing option or the debt was structured was such that the customer was able to import those equipment, start generating income, and then repay the facility. Now, however, in terms of interest, they could service it because it was a running business. But in terms of principal repayment, which was tied to, the use of the assets, it was a longer tenor, and then it was matched with when we expected the assets to start generating income. So in terms of private debt, it's flexible. It's not based on collateral. It's based on cash flow, projected cash flow, what we expect the business to, to get in a couple of months. It's also very, in terms of pricing, it's also affordable, and because the risk is not, we don't perceive as much risk as the bank, so it's much more affordable.
And this is interesting to know, because it means with private debt, these businesses, they don't have to survive month to month. They can plan, more long term in terms of their growth strategies, because they now have a structured financing that is suited to their particular needs.
Yeah, private debts will definitely allow you reach your medium-term expansion objectives.
Okay, so I mean, let's talk about who private debt is for, because people like me, like I said, we're looking to start businesses. Is it just who exactly is private debt for? Are there certain kinds of SMEs is from, or are there specific kinds of businesses that are suited for SME businesses that private debt would be more suited for?
So private debts are basically suited for any kind of business. However, the business must be viable. There's certain things that we look out for. So one of them is character promoters. Who are people behind this business?
I have good character.
So character of the promoters. So who are the people behind them? What skill do they have? How do we know them? Do we know them as credible people in the industry? Have they been in this kind of business before? How well has the business run under them? And we also look at their skin in the game. What have they contributed into the business? Have they provided some kind of cash flow, some kind of capital to the business? As the business is expecting us to provide financing and they do nothing. So skin in game is very important. We also look at the viability of the business. I spoke about the FMCG distributor. I spoke about healthcare also. I spoke about fitness. Those sectors are very viable, so those are the things that we look at. We also look at your business growth strategy and plan. If you don't plan, people say if you don't plan, you plan to fail, right? So a business must have a strategy and have a plan to grow. So there are things that we look out for.
Okay, so it's not necessarily for early stage startups, but it's more like for businesses that are looking to scale and they are looking for the right kind of capital structure to support that
Well,
scaling.
well, to be honest, it's a mix. So you can have businesses that are already growing, and then you can have startups. I'll give an example of a startup that we financed. Also, it was healthcare. It was a business in healthcare. The promoters had just moved to Nigeria, and they were trying to open a business, open a hospital in Nigeria. We looked at the industry, it was viable. We looked at the kind of people behind the project. We had already checked everything out, and it looked like a business that we could finance. So it's not just for businesses already expanding, but also for businesses trying to start up.
Okay, I mean that sheds way more light on it. So not everyone can just jump out and say there has to be some viability to that business
Yeah.
before saying it's suited for you. So I mean, like with all things in finance, there are always misconceptions. People say one thing and people misunderstand it to be another. What are some of the misconceptions or barriers preventing SMEs, small and medium-sized enterprises, from exploring private debt as a solution to their capital needs?
I think the first one has to be lack of information. Many people don't even know that it's aware. It's available. So lack of awareness, lack
So
of
we're
information.
giving them that information now.
So lack of information. The second one is pricing. They expect it to be, more expensive than bank loans. Another one is they so expect stringent cash flow. Meanwhile, facilities or financing is based on cash flow. We don't lend against collateral, we lend against cash flow. So those are the misconceptions that people have. And then also people think that it's for large corporates and not for, SMEs.
Okay, so I mean, it means that in reality, they can approach company like Cardinal Stone Finance
Oh,
and
yeah. Yes, that's really what we're here for. So definitely they can approach us and we're able to structure and give them the best financing needs. Yeah.
if you are listening, you know how we say it. You think finance, you think Cardinal Stone.
Yeah.
Think debt solution, think Cardinal Stone.
Yes.
Okay, so I mean, this has been a very insightful session. Before we go, do you have any last words for any business owner, entrepreneur, anyone looking to raise capital currently listening?
Okay. So I'd say build a strong financial record. You need to start keeping your numbers. You need to start keeping your numbers. You want to do it personally, you want to get somebody to do it. You need to build a strong financial record. You must also plan. You must also have a strategy for growth. So if a business without direction, people will not want to finance such business. You must also have a strategy for growth. Finally, I believe that you also focus on your growth, on your business growth. Explore several financing options. I think that's about it.
Okay, thank you so much, Awele. But before we go, let's play a quick game, my favorite game. So I'll be making some statements relating to some of the things we've discussed, and you'll be telling us if they are myths or facts. So I mean, first statement: private debt is only for large corporations. Myth
Definitely a
or
myth.
fact?
Definitely a myth. It's for medium scale companies to large corporates.
Okay, bank loans are always cheaper than private debt.
Oh no. So cost is based on the structure and flexibility of the transaction.
Okay, you need heavy collateral to access private debt.
That is also a myth. Remember, lending is based on cash flow and not on collateral. And not just on collateral.
Okay, private debt can help businesses fund expansion.
Yes. So that is a fact because private debts will help you meet those your medium term expansion projects.
Okay, only struggling businesses seek alternative financing.
That's a myth. Around the world, businesses scale up with the use of financing and debts. So that's a myth.
So that my business that is struggling. There's hope for us.
There's hope for you.
Okay, I think this has been a very insightful conversation, and thank you so much, Awele, for joining us today. And to our listeners, to investors, people looking to start businesses, business owners, I'm sure you must have gotten a lot of insights from this conversation. Awele, thank you so much for joining us today. This has been a very insightful conversation. So, I mean, we would like to hear more about Cardinal Stone Finance and how it's positioned position to offer financing solutions to any business owner listening right now.
Okay, thank you. Cardinal Stone Finance is the financing arm of Cardinal Stone Partners, and we provide specialized financing, everything private debts to our clients. Now, it's across sectors, so please reach out to us. We'll structure the best finance solution that you require. Thank you.
Okay, thank you very much. Now my business that I've been talking about, so I'll definitely be reaching out.
We'll be expecting
And so
you.
our listeners, thank you so much for listening in today. If you found this episode helpful, remember to share it with your friends, business owners, entrepreneur, and really anyone that is interested in Nigeria's economic growth story. And if you'd like to explore financing solutions for your business, you can reach out to the Cardinal Stone Finance team. Until next time, stay financially focused.